which is to say that this Friday, there's two things that are happening. We do have an index rebalancing coming up. This means that we could be seeing up to $11 billion of NVIDIA shares purchased and about $9.9 billion worth of Apple shares sold. That's not the only thing happening this Friday as we look at the ETFs being rebalanced. It's also a quad witching day. This is a day where we typically see a little bit more trading volume. Options activity actually in trade execution can be somewhat slightly improved. But these are liquidity events, Tom, and they can force major positioning changes. So without scaring the children out there, I was hoping that in your humble experience, you could explain to everyone what we should be or not be expecting for this quad witching this week.
Usually what moves quad witching rebalancing, interest rates, it's rarely stocks. Let me explain. The idea that there is a rebalancing coming, which just means that, you have to, like you said, sell Apple, buy NVIDIA. If you want to do it with zero risk, you just wait till they close and you put a market on close order and to sell Apple and buy NVIDIA. And wherever Apple closes and NVIDIA closes, there's no risk. But most firms don't do that anymore. And knowing that there's a rebalancing coming and knowing that there's stock to buy, they try to add a few ticks to their returns and try to jump all over that early. So my guess is that a lot of the rally in NVIDIA already has been people kind of trying to race that move, just get there before the actual close on Friday. Most of the things that move indexes for rebalancing and get firms to cover index positions, things like that, it's mostly just interest rate related. I just don't think it's going to be that big a deal. Triple witching is really for unloading existing ARB positions because it's the only time you can get out with no risk. Most of the real rebalancing comes at the end of the quarter. So it would be really rare for me to think that you're going to see a huge index rebalancing on a triple witching. Most of the rebalancing will come at the end of June. I think most of what we're seeing now will come with the decision on if you don't get out this Friday of your index ARB positions, then you have to hold to September because there's no other outs. It's the only out you get is once a quarter. I think that's the real question, and I'm not sure how to answer it because I don't know what it means. So far, interest rates have gone slightly lower, which means the short stock rebate is less than you might have been anticipating, or maybe for some people it's higher. I don't really know. But whatever the case is, when interest rates go higher, there's usually stock to buy. And when interest rates go lower, when bond prices go higher and interest rates go lower, there's usually stock to buy. And the reason for that is because your short stock rebate is worth less than it was last month. So your short basket is less attractive. And then you'd rather have the cash. That's the only thing I know what works. I don't know if you can actually game the NVIDIA rebalancing.
Yeah.
I have no idea, Chris.
I mean, obviously most people hearing this are probably like, oh, so this means they're going to be buying NVIDIA. I can get in and get some long NVIDIA, and they're probably going to be selling at the expense of Apple, and so Apple's going to go down. And I just don't think it's going to play out that way. I mean, this thing is already well known. It's already well telegraphed. This is one of those times where you talk about all the information is known in the market, and therefore I don't see an ARB opportunity, if you will.
Chris, I would wonder why would anybody do an index rebalancing on a triple witching? I've never heard of that before. Mostly all the index rebalancing would be end of quarter. I mean,
so when I say rebalancing, XLK, the technology ETF, is going to be rebalanced. And as a result, NVIDIA is going to be the largest component of it behind Microsoft, switching spots with Apple effectively. And it's such a large switch that NVIDIA goes from being like 4% of the ETF to basically 21%. And Apple goes from being around 21% to around 4% just because of the index, this particular ETF's rules. But that raises exactly the question I was going towards, or where I wanted to land this conversation. I think you guys would then both agree, Jamal, in particular, where you're talking about the efficient market hypothesis. I've already seen some research notes. I've seen some things in the news on various financial blogs, people on Twitter talking about this quad witching coming up as being a massive liquidity event. And to a certain effect, it is. There's going to be a lot of trading activity. That's what typically happens on these kind of days. But if it's something that warrants us acting on, is a different story, because this calendar's been known for months in advance. People model out the changes in these ETFs, these ETF flows and weightings all the time. In fact, there's a tool on the Bloomberg terminal that you can go to and punch in, if the market closed today, what would be the rebalancing for XLK? So this is all public information, which means it's already reflected in the share price. I always want to use this segment as a cautionary tale of don't get sucked in by this term. It's not necessarily something that's going to really move the market. It does mean that positions change hands. It does mean that people move around their books. But in terms of provoking a significant breakout or breakdown, expecting a significant 2 standard deviation move on Friday because of this liquidity event, let's slow our roll there. The table isn't necessarily set for that. And history tells us that's usually not how it works out. So don't be alarmed by this term that some people are throwing around, quad witching and liquidity. It's not really something that may necessarily be tradable.
I think for 40 years, I've been trying to guess which way the market's going to go on expiration. And I think for 40 years, it has surprised me almost every single time. It surprises me when I'm right. Let's put it that way. I don't care who you are and how much market experience you have. I'm not sure it's something that's very easy or predictable. And I don't care who you are. I just don't believe it's. And if you looked at triple witching over the last 2 years, or 3 years, I believe, 3 years, the results are incredibly poor. When for 20 years before that, they were almost up 80% of the time. Now it's like down 90% of the time the last couple of years. So I have no idea what to make of it, Chris. I honestly don't think there's a trade there. I mean, I don't think there's a triple witching trade. And the scary thing for me, I would think the other side of it's actually a little more scary, which is with the VIX one day. I think I looked yesterday, and it was like a $38 move for 2 days, like $19 a day or something. And I'm thinking to myself, how would anybody in their right mind, the risk reward on that trade is so bad. I just don't like it at all. In other words, the expected move that the market has priced in for the rest of the week with the holiday tomorrow, it's not worth it to be short weekly premium in here. Yeah. I just don't see it. I mean, there's no payout. You're basically flipping a coin for, an even money shot at best. I just don't, there's no juice.
None at all. Because the market's not expecting anything. We don't have any real catalysts right now, and it's just that kind of week. Honestly, next week is going to be a little bit more the same. The week after is a little bit different. The week of 4th of July, oddly enough, we got a couple of different catalysts in that week with the jobs report, a couple of things like that. But yeah, these next couple of weeks, it's going to be slow sledding, it seems like.
Yeah, I always like summer trading because people don't think anything's going to happen, and usually stuff happens. So for that reason, I like it. But right now, the marketplace is not pricing in anything happening. We haven't seen 1 day VIX. And I asked the research team to cover this actually on the 1 days to take a look and see, how much risk is there. And I don't know if we'll get it done today or if it'll be the next piece that we do. But I want to see how much the risk there is when the VIX 1 day is under 10 and under 12, because that's where we are right now. And this is a very directional marketplace. And I think that is the hardest marketplace to trade.
Yeah, I'm looking at the 1 month straddle right now in SPX, 132 points.
132 points. We moved 132 points last week.
I think this pertains more to me and Jamal. And Tom, I know that you say oil's a one-trick pony, and certainly right now it's not that appealing. When you look to the IVRs in crude, it's 3.1, which isn't exactly something that we should really be paying much attention to. But technically speaking, we did break the downtrend from the April and May swing highs. We've moved back above $80 here today, and it feels like it's for a familiar reason. Apparently, Israel is getting ready to go to war with Hezbollah in Lebanon. So this is a market that's being ruled by fear. The one thing that I find different this time around is, unlike the headlines that drove oil prices move to the upside back at the end of March, in April, this is not being accompanied by an expansion in volatility right now. The IVRs in oil back then got up into the 30s, I think even to the 40s at one point, but that's just not the case right now. And so while there's a strong tendency that, Jamal, you and I think are both on the same side of this now losing trade, we're both short MCL, it's increasingly difficult for us to maintain this view because the vol's not there, one, and two, the market's breaking out. As someone who's like putting on iron condors around these levels in the past, I got to say the lack of volatility makes it rather unappealing. The risk to reward, I don't think, is there right now. And if we're in the early stages of a market being gripped by fear, then a further push to the upside is possible, which is to also say that we're back in a territory where we were at the end of March. Tom, you and I were talking back then on this very show. Let me explain. What happens when oil gets above 80? What happens when it gets above 85? How does the bond market react? Does it become a problem? And I would point out that funny things tend to happen in the bond market when oil sees that 8 handle on it. We're not there yet. and bonds have been performing well. But if you've been someone who thinks that this bond market rally has gone too far too fast, and you look at the oil chart, maybe with the, say, 40 something IVR and say ZN, there is an opportunity to look at a condor there instead. We can express that concern about oil prices going higher through the feedback mechanism of inflation expectations through the long end of the treasury curve, which is why I have on a condor in ZN now, because if oil's breaking out, then bonds probably can't rally that much more here henceforth, even if those Fed cut odds stay elevated. So yes, the bond market was dead, but the vol is back in certain corners. ZN is very approachable. I like the condor in ZN, Jamal, and I know you do too, because we had a condor show last week on Futures Power Hour, where that's basically all we were doing.
Pretty much, yeah. I mean, we're condor twins right now. I got the condor on in ZN. I really believe more than anything that bonds are going to trade sideways for a little bit. And as far as oil, look, I know there is another conflict. I don't hear the echoes for that as loud as they have been in the past, right, with Russia, Ukraine, or even earlier, or late last year, we were hearing what was going on with Hamas in Israel. But this just move higher just looks like it's a good time to sell. And you're right, funny things happen around 80, but we've also seen oil retreat from 82 when you look back over the last since May. So it seems like a good time to get short.
I'd be ranking oil as 3. It's very unattractive to me at these current levels. From a premium perspective, it's very unattractive. So
what direction though?
I'm not, it's been 70 to 80 basically forever. Now it's wrapped on the high end of the range. I mean, if you're going to trade directionally, I'd probably get short because I think it's still going to the 60s. But you know what? There's no risk. There's no juice in the calls. If you look at the calls in crude oil, when there's something to do in crude oil, like when I feel like the calls get jacked, there's nothing there right now. Calls and puts, the options are so cheap in there, it's crazy. So that's my only, I don't, whatever oil position I had on, I took off. I just don't see anything there.
60s? When's the last time we were in the 60s?
Well, Tom, that's why it's, if you're going to be short, that's why Jamal and I both have the MCL exposure on, because the options play, really the juice ain't worth the squeeze.
Yeah, I agree.
But we've seen historically, at least recent weeks, when oil prices get above 80, it becomes a proverbial albatross around the bond market's neck. And with a 46.8 IVR in ZN right now, you could perhaps play this as somewhat of a proxy trade to get a little bit more of that volatility juice.
Look, this is not the exact science, okay? But for me, anybody just pull up an oil chart, look over the past year, hold your cursor on 80. Just do that. That's why I'm short oil, right? When you do that, you see why I'm interested in being short oil.
If I had to pick a side, I'd be short it, but I'm in no position.
It's like a lopsided sine curve, and most of it is under the line.
Yeah, I just don't sell anything with IVRs of 3. I just don't like the risk reward.